Has Michael Burry just gone crazy? Yes, the trader known for the big short is at it again, selling all but one stock and loading up on puts just as the US 30-year hits 5% once again. So what does this all mean as we now have the largest level of shorts ever recorded on treasuries? Well, in today's video, we take a look at what this is telling us in terms of structure, potential overbought natures in the markets, and whether gold can actually come back in light of the last big move. Guys, there's a lot to discuss. Let's get into it together. These are some huge calls being made on the street. Stocks, commodities, and cryptos. Let's look at it right now. Well, welcome back, everyone. It's great to have you here. My name's Tom, and in today's video, we have a lot to discuss. It may look like a equilibrium or doji candle over the last 24 hours, but take a look what happened underneath the hood. For the first time in a while, we turned defensive. So what does all of this mean? In today's video, we'll take a look at the macro and, of course, the key levels and data together, along with what Michael Burry's up to. But just a quick reminder, if you're from Sydney, Australia, or you're able to attend, come to our 4th of June trading event. It's completely free. We've got drinks, we've got a little bit of food, and of course, we'll be sharing with you some amazing stuff. Also, it's great just to meet people in the community and for you guys to potentially network and meet lifelong friends. All right, let's go through what is happening as Michael Burry makes one of his biggest calls of all time. He has sold everything in his portfolio but one, which is the Estee Lauder, and he has then loaded up on the puts. Yes, he's betting against all these big names. He's going against Barber. He's going against Nvidia with his largest position, and it looks like he is calling for another big short. Now, as we know, he's done this a couple of times over the years, and he's generally been a little bit wrong. However, is this time different? Well, let's take a look at the nature of this current recovery. And you might be thinking this is the most insane market of all time. But actually, it turns out after we sell off, we tend to recover with pretty quick movements. In fact, 23 trading days to get off the bear market low is pretty normal. And one of the reasons why this happens is because, of course, often you could call it a dead cat bounce. That is, the market gets ahead of itself and then potentially sells. Now, we've seen Paul Tudor Jones, we've seen other people out there, and I guess Michael Burry in some ways, now calling for the market to make a new low and that everything is about to turn incredibly bearish. And at the same time we see this, we now have treasuries with the largest short interest of all time. Yes, according to Subu Trade, we have now seen short interest just spike over the last week, and everybody is betting against US treasuries. But really, should they be? Well, over the last 24 hours, we actually saw a large trade come in, and somebody may have been trying to buy the dip. Now, while I don't like trading treasuries, I think they're more of a multi-month or investing process, it's interesting to see this level once again find some form of what we have to assume at this point is probably buying support. And it happens right as we hit new peaks on everybody starting to short treasuries and trying to get out of them. At the same time as this happens, we've seen a spike in markets like no other past that US-China news this week. And of course, semiconductors and technology leading the last 5 days. But something happened over the last 24 hours. We started to see the market turn defensive right at this potential call wall. And as you guys know, and we spoke about in the previous video, we talked about this 5,900 level on the stock market being a massive amount of calls and a huge amount of expiration. And at the same time, we're seeing the same thing happening with Nvidia, Tesla, and some of the other largest options traded stocks. So while that's happening, while we're still at this resistance, we have utilities, the number 1 performer, gold stocks, the number 2 performer, and staples, the number 3 performer. And you guys would know they are defensive positions. So that's the first time we've seen this market turn defensive over the last 2 or 3 weeks as we approach near these highs. So could that mean that we're about to sell off? Well, one thing I just thought I'd throw in here was a quick random stat about healthcare. Healthcare has been getting brutalized. Of course, the administration in many ways going under after it. But according to Jason Gotford, this is actually the 5th time healthcare has ever closed positive on a day it fell to its 52-week low. And the stats around that, not too many stats obviously, are very, very bullish indeed. So could that be another market that's actually turning defensive even in the state of all of this terrible news for it? Well, let's have a look at one of our favorite reads, the Bullish Percent Index. Posted this account over on our account and X, links in the description down below if you want to follow us there. And as you guys know, we've used bullish percent index several times on the channel to not only pick lows in markets, like similar recently, and also to pick potentially turning points as we get overbought. And whenever we go to this 75 level, which we just hit, we start to say, has this market topped off for now? Is it too overbought? Well, the same thing is happening on both the S&P 500 and of course the NASDAQ. And you can see here that often when you see the bullish percent index for the NASDAQ come through and it gets above that 80 level, you have to start saying, was that too fast, too quick? And there are many, many reasons why people are starting to believe this. The percentage above the overall moving averages, such as the 5, the amount of growth in leveraged ETFs skyrocketing over the last couple of sessions as retail FOMOs in, and of course the RSI being above 70 as well, which tends to mean, at least for a little period of time, we may be looking at some kind of lackluster return. And that doesn't mean the market is going to a new low. We don't know that at this stage. In fact, everything we've been suggesting over the last kind of 3 weeks has shown us that breadth thrusts are here to stay. 70, Zweig breadth thrust, and the DeGraaf as well have people generally lining up to buy stocks. And why wouldn't they? When we look at even most of the stats, even in the worst case, if we now see sell-offs from this overbought RSI, it tends to lead into markets that while they do decline, in fact, 91% of the time they decline over the next 4 days. Remember, we're 1 day into this right now, so that'll be interesting. But generally speaking, if you look at something that's 1 month later, 2 months later, markets again tend to recover. And the worst sells that we've seen during these times are these here, including a 12% sell-off, which, is kind of bad, but still doesn't even take us near to where we were in terms of the lows. Now, some other reasons people are, of course, feeling quite bullish about markets: percentage of stocks above the 200 DMA. It's a big deal. When you break the 200 daily moving average, while pullbacks do end up occurring, generally to it or even below it, they don't tend to be the weakness that most people expect. And of course, we've seen this several times over the last decades, and they tend to be pretty good. Another factor for bulls right now is that since the 1950s, in fact, 1957, we haven't actually ever seen a market recover in the percentages that it's done so far while not making a new all-time high. In fact, the worst one was a 16% recovery with a new low. We've never seen something go to 17, 18% or even more without making a new high in that potential sequence. So could we be lending ourselves into a couple of decent months here and then potentially Armageddon? Well, this is, of course, what Michael Burry is betting on. He's betting on a huge shift due to tariffs and potentially just debt in the system, and he's going ultra, ultra bearish. Do you agree with him? Let us know in the comments down below. But maybe he's following something like this, which is a massive administration change that changes everything, and we know that the market tends to not like that over the longer term. In fact, Trump's first 100 days tend to be following that of Nixon, FDR, and some other presidents. And we can see here that while markets have recovered during those times, they've tended to have very bad late years. And this could also line up very nicely with that idea of the third quarter not being very good. So where are we right now in the cycle? Well, we've argued that we're in later cycle, which usually means we've got between 1 and 2 years more to go. And we started to think that late last year. So realistically, we're in the thick of it now. And if you have overlays, the most overlaid pretty much market that we can look at is this 1960s or the 1990s bull run, tech versus AI this time around. Now, we thought that we were in the 98 kind of narrative, which of course was a market that would recover back to the supply, then potentially drop down a bit and then recover up. But the US-China trade deal obviously rallied it through that point, and now we find ourselves around here. So are we more at a 96 level, or are we more just kind of near the end as markets blow up big time and then ultimately turn pretty bad? Well, of course, we don't know that yet, but we do use these overlays along with other tools. And one of the good tools for the bulls is that we've seen tech and semiconductors lead the rally, which is usually what you want to see. Large trades, no real updates here except for Bitcoin. We thought we'd just kind of show you the dark pool here at the top for Bitcoin, certainly a large transaction. And as it turns out, if you actually have a look at all the same sizes, so these are 565,000 share positions, these have all been the same size. So I would say it could be the same trader, maybe a trader going for a sell, trader going for a buy, trader clearing that buy, then making a decision that they want to get back into it because they're like, you know what, the price action looks like accumulation. And then possibly, is this a sell? It's literally the exact same size position. So could it be the same person? Hey, it may be. Gold silver ratio still holding, as you'll see later on today's video, although gold and silver both recovered off what has been a pretty bad sell on them in recent days. So let's have a look now at the S&P 500 and central bank liquidity. Central bank liquidity ticking up off Jerome Powell over the last couple of sessions. And could that tell us that the market is starting to get a bit more liquidity in it? That's lucky, because if we don't get liquidity at these points, I think we could be in for trouble. But the S&P 500 is making its way towards 59.50. And we know that this area between 59 and 59.50 seems to be where the resistance is. Now, in terms of if we see a sell-off, what becomes now the most likely level that we'll see the street try to reactivate in? Well, of course, it's the 5,600, 5,660. And the reason why, it was a supply becomes kind of a resistance area, and now this is a demand. So if the market comes back down, we have a lot of confluence sitting all over this exact zone. Now let's have a look at the US 500 in terms of futures. You can see here that it's still making its way up here on the 2-hour chart, coming back down over the last 24 hours. The NASDAQ actually having a pretty decent trade on it that was replicable and then going to a new high. So we still have a series of higher highs and higher lows and higher highs and no lower lows. So update the charts. The big thing here to look at is going to be 58, 40, 45 over the next 24 hours, 48 hours. If we sell underneath that, we've finally changed trend, at least on the smaller timeframes, 2 hours, 4 hours, etc. New options, high and low levels are open. And of course, the next resistance, we're getting towards that 59.30, 59.50 zone. Let's have a look at the options. The options tend to agree with us. We have a lot of calls at 5,900. We have a lot of calls at 59.50. So this is the slot where the market is going to want to hold into expiration to make the most amount of money. And if we continue on next week, you can see here, people are getting ultra bullish, 6,000 now as well, becoming a call level. So we are still in positive gamma. Markets are still to the bullish side. We haven't seen the price action line up yet with the bullish percent index and with the RSI overbought and all of those types of things. Remember, those other indicators, while they're early warning signs, ultimately price has to come with any type of movement. Going against it, you can get kind of hit, and that can be quite nasty. Let's take a look here at NVIDIA, 135. We know it's a call wall. We know there are options all above it, and that's why it's kind of being held to this area. And you can see as well, next week's expiration is the same, 135, 135. And on Tesla, it's the same thing, 350, 350, 350. The most struck level, the biggest level for either a big squeeze to the upside or Wall Street to say, you know what, enough's enough. We're stopping it right here, right now. So we are literally at that point where you could make either case scenario. And one of the things that happened over the last 24 hours was that yields spiked up to 5% again, and then very quickly dumped back off that level. Now, we know that if we close above 5%, we've got what we call a breakout in technical terms on yields, and that can start to squeeze to the upside, as we do know that there are a lot of positions that may need to be hedged around here. Now, one of the big things about this is we also saw last time fear within the administration and the Fed at around 5%. So remember, this is still a very key level to look at. We're looking for a close, and we will be paying attention to it. What about options and bonds? Do we see any movement in the spreads? No, it's still pretty cautious in terms of we've been risk on the whole time. We do not see an early warning sign of risk off yet from that particular indicator. And in terms of our bonds indicator here, you can see that we have not seen any signs of weakness. So what we're looking for is divergence. We want to see this going down, stock market going up or holding. If that happens, I usually trust the bonds market a little bit more than I trust the stock market. So it can be a clear early warning sign, but we don't have that at this stage. Let's have a look at silver gold ratio. You can see here silver holding its own versus gold, although both fell off. And of course, this is showing us something similar. We're still looking at potentially silver being superiorly undervalued to gold. But let's take a look at the US dollar for a second, because it was falling over the last 24 hours. It didn't come down that much, but it's certainly still holding up around this area of 100 parity. Now, if you're a bull of the dollar, you want to get above 101, and then that should be able to pull to 102.50. And if you're a bear in the dollar, you want to break below that parity zone. But gold did spike back up. Is it out of the problems yet? even though that was a huge move for gold and certainly a encouraging sign, you can see here we're still below that last swing. And I think 32.75 is the key level for the bulls to break out from. And if they do that and we end up getting a weekly close above here over the next 24 hours, boy, oh boy, gold could start squeezing pretty hard. Still in a downtrend though on a lot of these time frames. If you go smaller, like 2 hour, you could make a case for trying to get bullish again at around 31.70. And I think day traders will have several key levels. There's both bull and bear positions that could potentially come in over the next kind of days. For silver and oil, let's just quickly look at oil. Oil at resistance still, but we'll go to silver and take a look at this. It's held better than gold. So it didn't actually manage to close below these serious supports, and it's come back up to the most traded level. So the most traded level is literally 32.60, and that zone is still being tested. So for silver to really recover properly, it's going to break 33.20. And then, of course, if you're really looking at the longer term, 34.50 is a huge level for silver, something that you may want to alert yourself to in months if that does end up coming through. Tesla, 350 call wall. You guys can see it. Absolutely where I could see people taking profit. We're starting to get a couple of transactions, but nothing massive to note. We'll update if that changes. Semiconductors, again, at resistance versus the SPY. Could be in for a bit of a breather here. And NVIDIA creating a long leg doji, which is, of course, an equilibrium level right at that call wall. So again, if these levels don't break, they are signs, along with the defensive nature of the market, that maybe things are starting to turn a little bearish. Google also at resistance, although still very cheap. In fact, I think the differential between the S&P 500 and Google's price is like one of the highest ever recorded. And HSI starting to see a little bit of selling as it has approached its resistance zone. So we're kind of getting this across the board, as you'll notice. US 2K, again, could be accumulating. You never can discount that. This could be all an accumulation for a breakout. Keep your mind open to further rallying. It is possible. But at this stage, it's resistance, so we don't know which way it's going just yet. And it is at that key zone. And the NASDAQ has created a long leg doji as well on the futures. I wouldn't say this is a critical, like, wow, I think this is an amazing area. But if we grab a fixed range, you guys can see here, it's trading right at that big heavy trade zone. So again, does it make sense to potentially see resistance here? Yeah, it does. And this is the first level other than this 20,800 that we could say even has any potential chance, and we don't have a low yet. Now, if you were trading this over the last 24 hours, the key level to watch was actually 21,176. We spoke about it in our private trading community, and we talked about the key technical zone there. It just wasn't able to break underneath, as you can see here. Mixture of 2 hour 20 moving average, anchored VWAP, and other reasons held it up. So actually another nice little scalp day to the upside. And for now, trend does still remain bullish, but this could be a key level to see broken. So 21,000, maybe 100 break below close. That could be a big update. Bitcoin looks like it's rejecting and trying to break to the upside, but still too early to tell. A lot of accumulation here, no new low being formed, and clearly something going on. What is it? We'll find out. We know there's a big dark pool trade there, that's for sure. So will they be correct again? Prelim UOM is the big news of the next 24 hours. The Fed does use that, of course, as one of its early key signs. But generally, to summarize today, I think we can say here, Michael Burry making a big call. Potentially, he'll be correct this time. He has made a couple of big bear calls, but he seems to be doing it while some other signs are coming through. I wouldn't say that I would pay attention to Michael Burry call on like a week or two. You have to be thinking about it from a 6-month, 12-month perspective. So do you agree with him? Put it in the comments down below. Of course, for now, on the smaller timeframes, we have a lot of signs saying the markets are overbought, but we don't have any activation just yet. We'll continue looking. We'll hunt with you guys. And of course, we'll hopefully find it together. Quick reminder, Sydney trading event, subscribe to the channel, follow us on X, and thank you so much for watching. Bye for now. We look forward to coming to you on the weekend with hopefully some big closes and information. Ciao, guys.